if you're following the financial news at all right now, the scale of this AI boom can feel, well, a little overwhelming. It's not just a trend. It's like a modern-day gold rush.
Exactly. And the smart money in a gold rush, it isn't always on the prospectors.
It's on the people selling the picks and shovels.
That's our mission for this deep dive. We're going to look past the flashy AI apps and focus on the companies building the actual foundation. We've got sources detailing two huge players here.
Okay, so first we're diving into the undisputed king of AI hardware. That's Nvidia, ticker NVDA.
And then we're going to contrast that with a really interesting challenger, a high-growth cloud services company called CoreWeave, ticker CRWV. This is really about two very different ways to win in the AI game.
Let's start with the champion then, because Nvidia's numbers are, frankly, historic.
Oh, they're staggering.
Their stock has just exploded over the past decade. It's made them the world's most valuable company with a market cap of, what, $4.62 trillion?
It's almost hard to comprehend. But the key thing to understand here, the real insight, is how they evolved. For years, Nvidia was just a gaming company. They made the best GPUs for high-end PC graphics. That was their whole identity.
But they saw that the parallel processing power you need for amazing graphics was also perfect for machine learning.
Exactly, for the huge computational load of AI. So they didn't just pivot, they completely remade their business.
And today, the vast majority of their revenue, it's not from gamers. It's from selling these incredibly powerful data center GPUs, like the H100s, to all the big cloud providers and enterprises.
They've basically cornered the market. It's a near monopoly on the high-end chips that make this whole revolution possible, and analysts see this continuing.
What are the projections looking like?
They're expecting revenue and earnings per share to grow at a compound annual growth rate, a CAGR of 40% between fiscal 2025 and 2028.
40%. For a company that size, that's just dominant, stable growth.
The definition of it.
Okay, so that sets the stage perfectly. If Nvidia is this massive, reliable bedrock, what happens when a smaller, faster company comes along and just uses that bedrock to build a specialized service?
And that's CoreWeave.
And this is where it gets really interesting for me, because Nvidia actually owns a 7% stake in them.
That connection is fascinating, but you have to hear their backstory. It's even better. CoreWeave did not start out as an AI company.
Not at all.
They were a cryptocurrency mining company. They use all these Nvidia GPUs to mine Ethereum.
Talk about a pivot. The crypto market just falls off a cliff in 2018.
Their entire business model, poof, gone overnight. But instead of just folding, they looked at their warehouses full of these powerful Nvidia chips and had this realization.
They realized they could repurpose them for remote AI workloads, from mining digital coins to providing digital infrastructure.
And they went all in. In 2022, they made this huge bet, spending around $100 million just on Nvidia's newest H100 data center GPUs.
And here's the critical part. The sources note they used those very expensive chips as collateral to get even more financing.
A really aggressive move. It let them immediately buy more hardware and start building out data centers like crazy.
You can see it in the expansion. They went from just 3 data centers at the end of 2022 to, what, 33 data centers across the U.S. and Europe today?
They're just scaling as fast as humanly possible.
So what's their core claim? Why would a company go to CoreWeave instead of the giants like Amazon's AWS or Microsoft Azure?
It's specialization. They claim their dedicated cloud GPUs can process AI tasks about 35 times faster and 80% cheaper than the big diversified cloud platforms.
Whoa, hold on. 35 times faster. That isn't a small improvement. That's a game changer.
Yeah.
How do they actually do that?
It comes down to how the infrastructure is built. AWS and Azure they're designed for what's called multi-tenancy. One big machine gets split up between lots of different users doing lots of different things. That adds overhead. CoreWeave, on the other hand, runs what they call bare metal GPU clusters. They are purpose-built for one thing and one thing only. Massive, complex AI jobs. They strip out all the extra layers.
So it's specialized versus general purpose.
Exactly. And this is the key insight for you, the listener. If you're a big tech company, why not just buy the H100s yourself?
Well, it's incredibly expensive.
Immensely. Building these data centers, buying chips that cost tens of thousands of dollars each, it takes a ton of capital and time. It's just so much more practical to rent that processing power from a service like CoreWeave. They sell GPU time.
So that efficiency is really the whole bull case for them. Let's get into the numbers, because they've landed some huge deals with Microsoft and OpenAI.
The numbers for 2024 show, genuine hypergrowth. Revenue shot up 738% to almost $2 billion.
Wow.
And their adjusted EBITDA, that's a key financial metric, it surged over 1,000% to $1.22 billion.
Those are just unbelievable numbers for a company that, like you said, was mining crypto a few years back. The future projections are even crazier.
Analysts are projecting revenue will grow at a KGR of 114% to almost $19 billion by 2027. Adjusted EBITDA is expected to hit nearly $14 billion.
And this isn't just hope. It's backed by actual demand, right?
That's the most telling part. Their total revenue backlog swelled to over $55 billion. That signed contracts for work they need to deliver. It just shows you how much pent-up demand there is for this kind of specialized service.
Okay, so if the numbers are so good, why isn't the stock valued even higher? I mean, with the enterprise value of around $64 billion, trading at 6 times next year's sales, it almost seems reasonable compared to some other AI stocks.
And that question right there, that's what leads us directly into the bear case.
Ah, okay.
When you see that kind of explosive growth, you have to ask one simple question. How is it being financed? And the answer is pretty aggressive financial engineering.
They're taking on debt, and they're issuing more shares. We've seen the number of shares go up by about 7% just since their IPO in March.
And the debt load is massive. Their debt-to-equity ratio was 7.5 at the end of the third quarter.
Put that into context for us. What does 7.5 actually mean?
Well, a ratio of 1.0 means your company is funded equally by debt and by shareholder money. A ratio of 7.5 means you are overwhelmingly financed by debt. It's risky, it amplifies your returns on the way up, but it exposes you to huge danger if anything goes wrong.
And we saw how willing they are to use their stock for growth when they tried to buy Core Scientific for $9 billion. That was an all-stock offer.
Which was rejected, but it signals they are very willing to dilute current shareholders to get the data center capacity they need, and fast. But the biggest red flag, the thing that really separates their risk from Nvidia's, is how they calculate profit.
You mentioned that adjusted EBITDA number, the $1.22 billion.
Right, but adjusted is the key word there. Adjusted EBITDA excludes some very real, very significant costs.
And for a business that is all about physical hardware, those data centers, those expensive GPUs, what exactly are they excluding?
2 huge things you just can't ignore. First, paying off all that debt we just talked about. Second, and this is the big one, depreciation. Those GPUs are not assets that last forever. They wear out, they become obsolete fast. Depreciation is the accounting cost of that hardware losing value.
And for CoreWeave, that must be a massive number.
It's enormous. By excluding it, adjusted EBITDA paints a much, much prettier picture than reality.
So if you actually include those costs, what's the bottom line?
Under standard accounting rules, or GAAP, which includes depreciation, CoreWeave is expected to stay unprofitable until at least 2027. That high debt, the dilution, the GAAP losses, it's a vulnerable position.
Especially when you add in their customer concentration.
That's the final glaring risk. They get roughly 70% of their revenue from a single deal with Microsoft.
70%.
So that incredible 114% growth projection we talked about, it all hinges on that one relationship with one tech giant. If Microsoft ever decides to build more of this stuff in-house or finds another partner,
That whole growth story could just collapse.
instant.
So for you, what we've broken down here are 2 totally different ways to invest in AI infrastructure. You've got Nvidia, the dominant stable foundation, the manufacturer projecting a solid market-leading 40% growth.
And on the other side, you have CoreWeave, the service provider. They're offering incredible speed and cost savings, and that's fueling that explosive 114% growth. But it comes with a lot of risk. Debt, dilution, and that huge customer concentration.
The key takeaway then is really understanding what part of the AI story you're betting on. The capital-intensive hardware maker with its stable foundation, or the high-leveraged service provider with its exponential but fragile growth.
And that leaves us with a provocative thought for you to consider. Given that CoreWeave's entire business is built on these rapidly depreciating assets, these H100s, and they rely on a metric, adjusted EBITDA, that ignores that depreciation, how long can rapid revenue growth keep funding this aggressive debt-fueled expansion before the market demands to see real, actual GAAP profitability? That's the trade-off, speed versus solvency, and that's the future of this AI infrastructure battle.